Ethereum has the most developers. It's programmable. It has the biggest depth. It's got the whole ecosystem, but Solana, Sui, much faster, much cheaper, much more efficient, different feature sets.
The Ethereum Foundation is back in the spotlight, and not for a reason investors are comfortable with. On May 1st, 2026, the foundation confirmed it had sold another 10,000 Ethereum in an over-the-counter deal worth roughly $23 million. The buyer? BitMine Immersion Technologies, a fast-rising institutional player led by Tom Lee. This marks the third major sale in just weeks, bringing the total Ethereum sold to BitMine alone to over $56 million. On paper, the reasoning is straightforward. The foundation says these sales fund core operations, research, development, ecosystem growth, and grants. But the timing is raising serious questions. Ethereum is still trading far below its previous highs, sentiment is fragile, and now one of the most influential entities in the ecosystem is consistently selling into the market. Investors aren't just watching this, they're reacting to it. Because this isn't happening in isolation. These sales come after months of gradual distribution that began shortly after Vitalik Buterin signaled a shift toward what he called mild austerity. What followed was a pattern the market didn't fully expect, and now it's starting to look like more than just routine treasury management. In this video, we break this down properly. What exactly is happening behind these Ethereum Foundation sales? Why is this latest move causing such a strong reaction across the crypto community? And what does this mean for Ethereum prices going forward? We'll walk through the full timeline, the on-chain data, and the investor sentiment driving this narrative. Then we shift to the other side of the trade, because while the foundation is selling, institutions like BitMine are aggressively accumulating. And later, we'll bring in expert insights from Raoul, Tom Lee, and Matt Hogan on what this means not just for Ethereum, but for the entire altcoin market. Before we get into this, make sure you hit the like button, subscribe to the channel, and turn on post notifications so you don't miss any of these updates. These are fast-moving markets, and staying ahead of narratives like this can make a real difference. On January 30th, Vitalik introduced the idea of mild austerity, positioning it as a long-term strategy to ensure sustainability while funding ambitious projects. He disclosed a withdrawal of over 16,000 Ethereum to support open-source development across multiple sectors. At the time, the messaging was clear, structured, long-term deployment of capital. But just 4 days later, the selling began. Between February 2nd and 5th, over 6,000 Ethereum was sold, then more followed later in the month. By the end of February, total sales had already crossed 10,000 Ethereum. The key issue wasn't just the size, it was the pace. What was framed as multi-year funding started looking like near-term liquidation. And the market noticed. Since February, the Ethereum Foundation has consistently sold Ethereum in tranches. Early February, 6,183 Ethereum sold. Late February, additional 800 Ethereum. March, first OTC sale to BitMine 5,000 Ethereum. April, 2 more 10,000 Ethereum sales. May 1st, latest 10,000 Ethereum sale at $2,292. That brings total recent sales to tens of thousands of Ethereum, with a growing portion routed through OTC deals rather than open market selling. This latest sale is different for one reason. It confirms a pattern, not a one-off, not a strategic rebalance, a consistent distribution cycle. And that's what's triggering concern. The reaction this time has been sharper, louder, and more skeptical, because now investors are asking harder questions. Why sell repeatedly at these price levels? Why such frequent funding needs? Why not accumulate instead? The optics matter. In a fragile market, even small signals get amplified. And here, the signal is clear. A major ecosystem player is selling into uncertainty. While the Ethereum Foundation is selling, BitMine Immersion Technologies is doing the exact opposite. They are accumulating aggressively. BitMine has now acquired over 5 million Ethereum, staked more than 4 million Ethereum, controls over 10% of total staked Ethereum supply, deployed over $500 million into staking positions. This is not passive holding, it's an active strategy. Unlike companies that simply hold crypto as treasury assets, BitMine is building validator infrastructure and generating yield through staking. That positions them as a core player in Ethereum's network economics. So now you have a clear contrast, Vitalik Buterin and the Foundation, distributing supply. Tom Lee and BitMine, absorbing supply. Now, to really understand what's happening here, you have to zoom out. Because this isn't just about the Ethereum Foundation selling Ethereum, it's about how Ethereum and Layer 1 blockchains in general are actually valued in this new digital economy. And this is where Raoul Pal's framework becomes important.
I've been arguing about this for a while. It's the whole discounted cash flow idea of looking at chains makes no sense. Because this new world, it's always going to route to the cheapest, fastest, most efficient, most intelligent, dense network. Because that's what agents will do. So it goes back to the old Metcalfe's law. And how I started thinking about this is, how do you value a layer one? Well, let's talk about Ethereum. The best way to value
conversation.
The best way to value Ethereum is say, okay, I'm going to turn the switch off. That's all of stablecoins, all of DeFi, every layer two, every NFT, all going to zero. Okay, that's the value of Ethereum. Do the same with Solana. Do the same with, and that's how you get the valuations. You invert it. It's the other way around. So they attract assets, capital, velocity, because they are dense with intelligence, because Ethereum has the most developers. It's programmable. It has the biggest depth. It's got the whole ecosystem. But Solana, Sui, much faster, much cheaper, much more efficient, different feature sets. And that's how I think about it. And the discounted cash flow model, where I've had that argument in the past, it's just nonsense. If I'm right, every agent will self-select away from any chain with fees.
Fees will collapse. Like we're already seeing, like on Sui and on Solana, that fees are 0.01%. Oh, sorry,
Sui just done that.
Other percent or less.
Sui are going to do stablecoins at zero cost. So that's zero now, which is the race. Everything digital goes to zero in cost. I mean, that's Wright's law playing out right in front of your eyes.
Right. Is that because they're capturing on the float? So they're basically creating their own stablecoin?
It's the yield and how you get the yield, because and what you do with that yield allows them to do that. So you can fund the cost and other benefits. You could buy back tokens, you could do other stuff, as opposed to keeping it as a profit-making entity like Circle does. You can actually reinvest the yields into the network. It's actually quite a smart idea.
Right. Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit, you could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth, tax-free. You keep the full $50,000. Same crypto, completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time. Pal's argument is simple. Ethereum dominates in depth and developer activity. But competitors like Solana are pushing hard on speed and efficiency. And if Pal is right, the long-term winner isn't the one generating the most fees. It's the one attracting the most activity. That's a big shift. Because it means metrics investors have relied on for years might not apply here at all. But this isn't happening in a vacuum. Crypto doesn't move independently of broader markets. And according to Tom Lee, what we're seeing right now in equities could directly shape what happens next in crypto.
I think that I'm going to look at this as a series of rolling bear markets, because we know the Mag 7 and the software stocks peaked a lot earlier than the broader market did. And then they led into the low, but then bottomed first and are rallying. So I think that we should expect breadth to follow, but it would be pretty textbook, because tech is what peaked earlier, several months earlier, before the index level market actually peaked. Well, I know strong markets tend to, and I'm going to sound not very original, but strong markets stay strong. So I think the strength that we've seen is a good sign. And we also know, when we look at the data, that institutional investors caught the bottom. But I think in 2026, it's retail that kind of missed the low, but they have a lot of firepower. So I think it's going to be a retail-driven buying of stocks. And that's why I think broadening can take place, because, as you know, retail investors do like small and mid-cap stocks as well.
But does anything worry you? Like the semis, some of these names, Tom, are just up insanely.
And it's great to see the recovery there because we know that there's shortage. We also have to keep in mind that earlier this year, they all went into a cliff dive. The multiples for the most important stocks are still very reasonable. As we know, NVIDIA is barely trading above a market multiple and still trades at a discount to what investors pay for, quote, safe stocks like Staples, Costco, and Walmart, which trade at almost 50 times earnings. So I think that the market is reallocating capital, which is appropriate, but I think that estimates are still too low in AI, and that's why we have low multiples, because the earnings are probably even higher than we expect them to be.
Lee's view is simple, but important. Markets move in cycles, and right now, leadership is rotating. Tech stocks led the downturn, then led the recovery. Now the rest of the market is starting to catch up. What stands out is who's driving this move. Institutions caught the bottom, retail didn't. And now retail is coming back in, with capital still on the sidelines. If that trend continues, liquidity expands. And when liquidity expands, risk assets benefit. That includes crypto. So while Ethereum faces internal pressure from selling, the macro backdrop might be quietly turning supportive again. And then there's the institutional side of crypto itself. Because beyond price action, adoption is accelerating in ways that weren't even expected a few years ago. Matt Hugin gives a clear picture of just how far this has gone.
I was just at a normal advisor conference, right? Nothing related to crypto. There were about 170 financial advisors in the room. The start of my talk, I asked them how many of them personally held Bitcoin or crypto in their own portfolios. I thought it'd be like 20, maybe 30. It was 150 people, almost everyone. It shows you how much we've normalized crypto, right? You have Morgan Stanley launching a Bitcoin ETF. You have Goldman Sachs launching a Bitcoin ETF. You have Charles Schwab saying 2 to 7% crypto. And then I'm boots on the ground, a room of 55-year-old financial advisors. They all own crypto. I think it tells you where this industry is going. It made me extraordinarily bullish for the next few years to come.
Outside of Bitcoin and Ether ETFs, what do you expect the best performing crypto ETFs to be this year?
Look, I'm really bullish on a number of the layer one blockchains focused on stablecoins and tokenization. So I think things like Solana are very well positioned. I think things like Avalanche are very well positioned. It's not an ETF format now, but I think most DeFi protocols are dramatically undervalued and will be re-rated this year once we get through the Aave mess and we start making some improvements on tokenomics. So I'm broadly bullish, but in ETF land, I would say Solana looks relatively cheap right now. I would say Avalanche looks relatively cheap right now. I think the reality of the layer one space, the programmable layer one space, it's likely to be an oligopoly of a number of high performant, high quality chains, maybe 3, 4, 5. Ethereum is the clear leader. I'm very bullish on Ethereum. Solana is one of those competitors, right? You look at Solana, you look at Avalanche, you might look at Canton. Those are among the viable competitors. And I think relative to its market cap, it looks pretty cheap, right? Its market share is larger than its market cap. That's often a good comparison to make. Makes me bullish. Well, look, if you look at the relative performance of coins recently, you've seen Bitcoin and Ethereum outperforming in part because you have both institutional ETF flows from major platforms and you have corporate treasury buying. Solana hasn't benefited from the corporate treasury buying, and it's early to the institutional flows because those start with Bitcoin and ETH. But I suspect that they are coming. So where could it, it'll certainly be, not certainly, there are no guarantees. I think it'll get into the triple digits. I think it'll rally back. I think it'll be outperformant for the end of the year.
So when you step back and connect all of this, a more complete picture starts to form. On one side, the Ethereum Foundation is actively selling, raising questions about timing, strategy, and market impact. On the other side, institutions like BitMine are accumulating aggressively, while broader macro conditions and liquidity trends are beginning to shift in favor of risk assets. At the same time, the way we value these networks is evolving. As Raoul points out, this is no longer about traditional metrics, it's about network strength, adoption, and capital flow. And with institutional participation accelerating, as highlighted by Matt Hugin, the foundation is being laid for a much bigger move, not just for Ethereum, but for the entire crypto market. If you found this breakdown useful, make sure you like the video, subscribe to the channel, and drop your thoughts in the comments. Do you think the Ethereum Foundation selling is a red flag or just smart treasury management? Let's get the conversation going. Thanks for watching and see you in the next one.